Now, you'd think all those problems offshore had gone away by the way the markets were behaving. Monday's meltdown across the world stock markets has become a global melt-up, all on nothing more than rumour that the printing processes are being warmed up by the G7 central banks, starting with the Fed. One mildly positive sign from Europe, though. Officials are quietly briefing that a plan is in the offing to recapitalise Spain's ailing banks. Here's Neil Woolridge.
European and North American markets appear to have forgotten the troubles of the past week and staged a remarkable turnaround, rising by more than 2% each.
We're still sort of haven't gained back anywhere near the losses we saw last month. So I think we're just at that period with all this uncertainty that unfortunately I suspect we're going to have a period of large intraday volatility of those 1.5–2% swings.
On many exchanges, it was the biggest rise this year and was followed by strong gains across Asia this afternoon. But the latest bounce came despite any tangible good news. The Federal Reserve noted just moderate growth in the US economy, while the European Central Bank kept interest rates steady and also gave its own sober assessment.
Economic growth in the euro area remains weak, with heightened uncertainty weighing on confidence and sentiment, giving rise to increased downside risks.
Investors, though, chose to focus on suggestions a fresh round of money printing, or QE3, might be coming in the US, and the growing rumours that EU and German officials are working on an €80 billion bailout for Spain's banks.
Spain is struggling to afford its own bailout of its banking system, principally because of the wave of pessimism sweeping through international capital markets right away and of markets' reluctance to lend to Spanish institutions.
The Spanish government have been sort of very hesitant to want to sort of issue Spanish debt to sort of bail out the banks. They're looking for a broader solution, and this really does come down to this broader European solution. Rather than sort of Europe giving money to the governments, can they sort of find some mechanism by which they, a European entity can sort of bail out banks?
However, the European Treaty forbids injecting money directly into banks, and Germany stridently opposes such a move, while the central bank itself seems reluctant to impose a solution.
I don't view as the ECB's task to push governments into doing something. It's really their own decision whether they want to access the FSF or not.
If the rumours are correct, the European debt plan will be ready by the end of the month. But it's still a question of whether the markets and, in particular, Spain's creditors will hold their nerve.